Welcome to another episode of AKA Ask Kevin Anything. For today's question, we go to the Woodlands, Texas. Our listener purchased and sold some stock during 2020 and asked, what is the purchase date and purchase price to be used for determining my taxes on the shares sold? The interesting thing here is that back in 2011, Congress concluded that taxpayers were underreporting capital gains on their tax returns. Shocking, I know, right? So they shifted the capital gain reporting responsibility away from the investor/taxpayer to the custodian or brokerage companies. So now custodians or brokerage companies report not only the proceeds of the sale, but also the cost basis and the capital gain or loss. When the purchases of the related sales occur after 2011, they are referred to as covered transactions, and the brokerage companies reports the sales, purchases, and the gains. If the investor does not sell all the shares of a given position, the amount of the gain will be determined by the cost basis method that the brokerage company uses. It's important to remember that when a taxable investment account is opened with a brokerage or fund company, a default cost basis method is established. However, not all investment companies follow the same default method to arrive at the cost basis. Most fund companies use the average cost method, while most brokerages use the FIFO, first in, first out, as their default method. Moreover, the default method may not be the best method to arrive at the cost basis for your tax purposes. Therefore, it's important to identify which method will give you the most favorable tax treatment before you sell your shares. You will have to indicate to your broker which method you would like to use to arrive at the cost basis. Do you think the selection of the cost basis method can make a difference? Yes, it can make a big difference. Getting back to our question, the FIFO method yielded a higher capital gain of approximately $340 over the last in, first out LIFO method. That's a 28% increase, and that's just one transaction. So which method should an investor choose? In the past, the advice was to use a method that would provide the lowest current amount of taxes, or whatever allows you to defer the most taxes. Today, there are so many more variables, including the threat of higher taxes impacting capital gains. This decision could also affect future and current retirees in terms of their Medicare premiums and the taxability of Social Security. Call us today and let's coordinate this decision with your overall tax strategy and financial plan. Please keep the questions coming in. For every question used on this segment, we will give $100 to a local food pantry. Together, let's make a difference.